Corporate finance practice problem using Excel. Cash flow impact of tax rate change. Get ready, it's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet and would like to follow along, note that we are in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. We have the information on the left-hand side, populating that into the blue area on the right-hand side. This time, we're going to make a change to the tax rate. So the other things we're going to be holding constant. We're looking for our cash flow, focusing in on the impact of the depreciation, but we're going to keep the cash before depreciation and taxes constant, as well as the depreciation itself, and look at the impact if we change the tax rate then from 40% to 25%. Once again, trying to get a feel for the impact of something like depreciation, which could be a significant impact on long-term decision-making processes, one that's different for financial accounting on an accrual basis when we deduct the depreciation versus a cash flow basis, but which has a cash flow component due to the complication of the tax impact on the deductibility of the depreciation possibly. Okay, so let's do our same calculation here. We're going to be picking up the earnings before taxes. So earnings before taxes and the depreciation, we're going to assume to be the 1 million. Then we're going to take into account the depreciation, assuming the depreciation is something that's not going to be a cash impact, but have an impact on the taxes. So that's going to be the 500,000. Let's put an underline here in the font group and underline. This is going to then be our earnings before the taxes. Earnings before taxes is going to be equal to the 1 million minus the 500,000. Then we're going to apply the tax rate to get to the taxes. The taxes impacted then is going to be equal to the 500,000 times the 40% tax rate. And then we're going to say our earnings after taxes, after we can calculate the taxes that we have now included the depreciation for, is going to be equal to the 500,000 minus the 200,000. Here are our earnings after taxes, font group and underline. But that's not our cash flow now. So now that we've picked up the tax implications, we can now add back in the depreciation, which is not actually a cash flow item, but has a tax impact. And that's going to give us our cash flow. The flow of cash is going to then be equal, let's use the sum function, trusty sum function of the 300 and the 500, giving us the 800. Let's put an underline under the 500, font group and underline. There we have it. Let's do the same thing again, this time changing only the tax rate to see what the impact of a change on the tax rate is when everything else is equal here. So now we're going to say, all right, let's do our earnings before taxes and depreciation is going to be equal once again to the 1 million. Same thing there. Depreciation, I'm going to say is just equal or plus to that item. We're going to say it's 500,000. Same thing there. Home tab, font group, and then underline. That's going to give us our earnings before taxes. Earnings before taxes is going to be equal to the 1 million minus the 500,000, or the 500,000. Now the taxes are going to be different because the rate's different this time. So we have the same 500,000 times, though, now difference here being 25%. That's going to give us the 125 as opposed to the 200 I believe we had last time. Let's put an underline under that, font group, underline, and then we're going to have the earnings after taxes now is going to be equal to the 500 minus the 125. It's going to give us the 375, and then we're going to add back the depreciation again because it's not an income, not a cash flow type of item. 500,000, font group, underline. That's going to give us our cash flow, which is going to be equal to the sum of the 375 and the 500,000. We have a difference then, calculating the difference of the 875 minus the $875,000 difference due to the tax rate. So once again, we want to get a feel for, especially as we think about long-term projects, thinking about long-term projects into the future, what's going to be the impact of including the depreciation on it has a significant impact. It's going to be counted for differently oftentimes on a financial reporting purposes because of different objectives oftentimes, and possibly on a tax reporting purposes. And then when we make the long-term decision, because we're often looking at our cash flow, kind of present value cash flow calculations, but we need to take into consideration then the tax implication of that depreciation. So we got to be considering, what's going to be the cash flow, what's going to be the impact of the depreciation, what will be the impact of the depreciation on taxes, so that we can then make our best long-term kind of decision-making processes.